So my name is Wei Ming, and I'm with Asset Exchange Company, and we primarily do 1031 exchanges because we are a 1031 exchange accommodator. When and how to get a 1031 exchange set up is very, very important. Let me tell you why. Just this week, on Monday, I had a realtor give me a call, and she said, hey, my client is going to be doing a 1031 exchange. I'll give you a call on Friday because they're closing Friday. She said she was closing Friday, but what she didn't tell me was she closed last Friday. It was a $2.8 million deal too, so it was a pretty big deal. So with a 1031 exchange, in order to set it up, you must contact the company to get everything set up before the close of escrow. If you try to contact them after, then unfortunately, it's a little too late. And here's why. If you are in constructive receipt of the funds from the sale of your property, doesn't matter if you've spent it or not, you are subject to capital gains tax. All right? So ideally, what you want to do is when you get into contract or when you open escrow, contact your 1031 exchange company and get everything started. So this way, you don't have to worry about trying to get it done last minute, all right? So for asset exchange companies, if you want to set up an account, all you have to do is provide us with escrow's contact information, and we will reach out to them to get a copy of the contract and title report to set everything up. That's what the 1031 exchange companies need in order to provide the paperwork, all right? So there are many reasons why investors want to do a 1031 exchange, and the main reason is that it allows them to defer the capital gains tax. How much? Well, roughly 1/3. All right, roughly 1/3. That's the general rule of thumb we use, and I can give you the breakdown of that in the next slide. But general rule of thumb we use, it's expect about 1/3 of your capital gain to go to taxes. Other reasons why investors may want to do a 1031 exchange is that it allows them to exchange into larger properties that's easier to manage, or they can exchange into multiple smaller properties outside of the state that you sell it in, or anywhere that you want in the United States. All right? Diversification, it's a great reason to do a 1031 exchange. Maybe you know a property in a really hot market right now that you want to get into, or you want to exchange it into areas like Texas or Arizona where you can get a lot more properties for your money, and that will allow you to get more rental income. Other reasons include the ease of management. Now, a lot of investors, they may have had their properties for a long time. They may not want to manage it anymore. So what they may want to do is they may want to exchange into something that's easier to manage or have somebody else manage it, right? And finally, exchangers or investors exchange because of the depreciation. If you have owned your property for a very long time, you may have fully depreciated your property, all right? By exchanging into a property of higher value, it restarts the depreciation clock as well as giving you more equity to depreciate. So for residential properties, that's 27.5 years. Commercial properties, that's 39 years, all right? So as I was saying in the previous slide, expect about 1/3 of your taxes to go to, well, 1/3 of your capital gain to go to taxes. Here's some of the breakdown. You have the depreciation recapture tax, you have the federal tax, you have the Medicare tax, and you have the state tax. Now, I'm sure everybody here don't really want to write a large check to the IRS, right? So here are some of the breakdowns. Depreciation recapture tax is 25% of however much you have depreciated your property thus far. So if you are an investor who have fully depreciated your property, 25% of that will go to taxes if you did not do a 1031 exchange. Federal tax is a little different. It's either at 15 or 20% depending on your income. So if you're single and not file jointly, if you make $400,000 or less, you're at 15%. Make more than that, you're at 20%. If you file jointly and you make less than $450,000, 15%, more than that, 20%. So now, many of you may be thinking, I may not make that much. So am I on the lower end of the bracket? Maybe at 15%? Unfortunately, that's not always true because that depends on how much you're selling your property for and how much in capital gain you may be getting. All right, so that could bump you up into the next tax bracket. And unfortunately, there's also Medicare tax now, which is at 3.8% if you make at least $200,000. All right. For those of us in California, the state tax is anywhere from 9.3 to 13.3%. Again, depending on your income. And once again, depending on how much you're selling your property for, it could potentially bump you up to the next bracket. With everything blended together, the average, or the general rule of thumb again we use, is roughly 1/3. Now, when you're asking us about 1031 exchanges, we can't give you financial advice, all right? We can't give you any legal advice, but we can kind of give you the general idea of how much in taxes you may owe if you did not do a 1031 exchange. Oh, that went really far. So, to determine how much of a tax bill you may be looking at, you find your capital gain. The way you do it is you first have to find your basis. You probably don't have to look at any of these numbers or try to calculate it yourself because that's what your CPA is for. That's what you paid them for. But if you want to do it yourself or kind of get a general idea of what your bill may be, this is the calculations you use. You first find your adjusted basis, which is, in this example, $425,000. The way you get it, it's first by finding what you purchased your property for. In this example, this person bought a property for $500,000, depreciated $100,000 of that property. That means he would subtract it. Any improvements that you have made onto your property, you simply add on to the basis. And again, this example, that comes out to $425,000. Now, depending on how much you're selling your property for, will also determine your capital gain. And in this example, this person sold for $1 million, has a basis of $425, and the capital gain comes out to $575. Now on the right-hand side, I'm not going to go over that because I don't want to bore you with it since you're not going to be doing the calculations yourself anyways. But it comes down to about $192,000, which is roughly 1/3 of $575, give or take. All right, may not be exactly 33% for you guys. Could be a little higher, could be a little lower. But always speak with your CPA or tax advisor to help you calculate these things.